coming to the topic of cost of capital. Okay. So I will come back to the leftover exercise sums, which is in the leverage chapter. So now, what is this cost of capital? Every organization has to raise capital to carry over its business. Correct? So, while raising capital, such capital can be in the form of equity, preference, or debentures. There is a cost associated to every form of capital which is raised. What is the cost of capital? That cost of capital, for equity, you call it the cost of equity. For preference share capital, you call it the cost of preference shares. And for debentures, you call it the cost of debt. The overall cost of capital will be referred as K0, which is the overall cost of capital, which will be an average of weighted average cost of capital for all the sources. Okay. So, whenever an organization is raising capital, the capital is a liability for the firm. The capital being the liability of the firm, the people who have sponsored for such capital will expect some returns for such capital. In case of equity, they will be expecting equity dividend. In case of preference shareholders, they will be expecting preference dividend. In case of debenture holders, they will be expecting interest. Such expectations of investors becomes the cost to the company, right? So we have cost of equity, cost of debt, and cost of preference shares. How are they computed? While finding cost of equity, there are three different ways of finding the cost of equity. One is the dividend model, where the cost of equity, which is K suffix E, is measured as D by P into 100. Suppose I say 100 rupees is the face value of the share. 10 rupees is the dividend paid in a year, which means, is it 10% on the value of share? So that 10%, how did I arrive? 10 by 100. That is what is cost of equity. Cost of equity is D by P into 100. This dividend model will apply when there is no growth in declaration of dividend. So, whenever an organization is raising capital, it intends to grow its business, right? So, whenever there is growth, that growth is measured as D1 divided by P0 plus G. The derivation of these formulae you will learn in final. For now, you just remember the formula. Dividend model is D by P into 100. Dividend growth model is D1 by P0 plus G. This I have already told in Miron-Gordon model of dividend policy. What is this D1? D1 is expected dividend to be declared. What is D? D is dividend. If the question talks about dividend in the present tense or in the past tense, it is D0. If it is talking about dividend in future, expected dividend, contemplating to give a dividend, considering declaration of dividend, in such case it is in future tense where it is called as D1. How do you measure D1? It is D0 into 1 plus G. What is G? G is the growth rate. How is this growth rate measured? It is B into R. What is B? It is the extent of retained earnings. Retained earnings will grow at the respective rate of return. So, how do you measure the cost of equity? It is the dividend, which is the expectation of equity shareholders. If you are following dividend model, it is simple D by P into 100. If it is dividend growth model, it is D1 divided by P0 plus G, where G is the growth rate. How will a firm grow? A firm will grow based on retention of earnings, which is reinvested into the business. So how do you measure the growth rate? The extent of retained earnings will grow at the respective rate of return. That is how the organization will grow. So whenever there is a growth, the cost of equity is measured as D1 divided by P0 plus G. There is one more model of arriving at cost of equity, which is called as CAPM model, where the cost of equity is measured as RF plus beta into RM minus RF. What is RF? It is risk-free rate of return. Beta is a measure of risk. RM minus RF is called as risk premium. RM individually is market return. So let me explain this formula. Suppose I have got 1 lakh of rupee. If I am investing in government deposits or in fixed deposits, I will get a return of 7%, say, right? In such case, investment in fixed deposits or investment in government bonds, there is no risk. I have a guaranteed return of 7%. But I am not happy with just 7% of return. I want 20% of return. In such case, I have to take the risk of investing in market portfolio. Portfolio is combination of investments made. Okay. So whenever I am investing, I have 1 lakh of money. If I am investing in a fixed deposit, I will get 7% as interest. That is the minimum expectation of return which I want. If I do not want such minimum return, I want more return. In such case, I have to invest in the market. It can be in shares, mutual funds, or anything which is listed in the market. In such case, along with the higher returns, I will have risk coming along. Correct? So, because market fluctuations will affect the value of the investment. Right? So, what I'm trying to convey is, I said I have 10% as risk-free rate of return. Suppose if market return is 20% and I want that market return, which means how much in excess of risk-free return am I wishing for, am I willing for? I am willing for 13% excess return. 7% is the return from government bonds. 20% is the return from market, which means how much is the extra return I am wishing for or I am willing for? I am willing for an extra return of 13%. That 13%, is it coming without risk? No, it is coming along with risk. So I find the risk adjusted rate of return. Beta into RM minus RF, that was 13% which I told you. Beta is a measure of risk. So in case of beta is 0.75, it will be 0.75 of the risk adjusted rate of return, which will be added to the risk free rate of return to know the cost of equity. So if I want additional return, it comes along with risk. So I find the risk adjusted rate of return. So I add the risk adjusted rate of return to the risk free rate to know my total return from equity. That is how cost of equity is measured. Here again in final level, you have a separate chapter for CAPM itself. You will find how beta is arrived. You will find how RM is arrived. You have a separate chapter for CAPM in final level. So how do you measure cost of equity as per CAPM? It is RF plus beta into RM minus RF. These are the three formulae for finding the cost of equity. What are the three? One is dividend model where it is D by P into 100. Next is dividend growth model, which is D1 by P naught plus G. Next is CAPM model, which is RF plus beta into RM minus RM. Beta is a measure of risk. Okay. Then comes the cost of preference shares. If nothing is told in the question about retained earnings, to whom does the retained earnings belong to? Retained earnings belongs to the equity shareholders. So cost of retained earnings will be the same as cost of equity. Okay. If nothing is told about cost of retained earnings, you will take cost of equity as the cost of retained earnings as well. Okay. Then coming to preference shares. Here preference shares I classify into two. One is redeemable preference shares and the other is irredeemable preference shares. In case of irredeemable preference shares, what is the cost for such preference shareholders? It is the preference dividend which is paid. So the cost of preference shares will be the preference dividend divided by net proceeds into 100. What is this net proceeds? In case if the face value of share is 100 rupees and if the company spends on flotation cost, what is flotation cost? The cost incurred for floating the shares in the stock exchange. So if the company incurs any flotation cost, suppose say 100 rupees is the face value of share. Company incurs flotation cost of 3 rupees, which means how much is the proceeds which the company is receiving? To get that 100 rupees, the company is spending 3 rupees, which means how much is the net value the company is receiving? The company will receive a net value of only 97 rupees. So that is what we call as net proceeds, which is D by NP into 100. This is when dividend distribution tax is not imposed on the company. We discussed one sum in dividend policy where the dividend distribution tax was exempt in the hands of recipient and was taxed on the company. When dividend tax is taxed on the company, when the company is supposed to pay the dividend tax, which means how much will become the cost of preference shares. It is not just the dividend which is the cost to the company. The tax on it also is a cost to the company now, right? So when dividend distribution tax is imposed on the company, the cost of preference shares will be D into 1 plus T divided by net proceeds into 100. It is 1 plus T. The tax will get added to the cost of preference shares if the company has to pay tax on dividend paid. Okay. Next comes irredeemable preference shares. There is no growth model in case of preference shares. So you do not have any G here. It is just D by NP. Then coming to redeemable preference shares. In case of redeemable preference shares, first let's discuss about the issue of preference shares. Issue of preference shares can be at par, at premium, or at discount. Similarly, the redemption also can be at par, at premium, or at discount. Okay. Assuming a situation where the issue is at par and redeemed at premium. Issue is at par of rupees 100. The redemption is at a premium of rupees 110. Just a random example. What is the cost of preference shares? The cost of preference shares will be the dividend which we are going to pay every year plus how much was the issue value? 100 rupees. But how are you going to repay them? 110 rupees, which means you are giving them 10 rupees extra on redemption. You are already paying them dividend every year. Already you are paying the preference shareholders dividend every year for the share capital which they have invested. So, given the redemption value and the net proceeds, suppose if the redemption value is 110 rupees, net proceeds is only 100 rupees, which means on redemption, how am I going to repay the preference shareholders? I am going to repay them 10 rupees extra. Is that 10 rupees extra one-time payment or is it going to be paid every year? It is only one-time payment, which means how much is the payment for 1 year? It will be divided by N, which is the life of the preference share capital, right? Because it is redeemable. Suppose they say 10 years. 10 rupees is the extra money which I am going to pay apart from dividend, but I am going to pay it only once, which means that 10 rupees is spread over a period of 10 years. Which means it is 1 rupee in excess paid every year. So it is D plus RV minus NP divided by N. The whole divided by the average of proceeds. Having received 100 rupees, I am repaying 110 rupees, which means it is the average of proceeds which is employed by the company. So in the denominator, it is the average of proceeds which is RV plus NP by 2. If I have to represent it as a percentage, I multiply it with 100. This is in case of redeemable preference shares. Here again, if this dividend is subject to tax and the tax is on the part of company to pay, it will add to the cost of the company. So how do you find cost of preference shares? Please understand, dividend distribution tax is different from corporate income tax. Okay. So only if a question specifically mentions about dividend distribution tax, you will multiply it with 1 plus T. Otherwise, you will just take the first formula. D into 1 plus T you will apply only if the question is specific about dividend distribution tax. Cost of preference shares when there is dividend distribution tax will be D into 1 plus T plus RV minus NT by N divided by RV plus NP by 2 into 100. RV is the redemption value, NP is the net proceeds. Having received 100 rupees, you are redeeming it as 110 rupees, which means 10 rupees extra the company is paying. When the company is paying extra, it is cost to the company. That 10 rupees extra, they are not paying every year. They are paying only once. Divide by the life. Okay, that is why it is divided by N. Divide by the average proceeds which is used by the organization to make such profits, to give dividends and to provide premium on redemption. So it is divided by the average proceeds into 100. This is in case of preference share capital. Then coming to debentures. Here again the debentures are classified into redeemable debt and irredeemable debt. What do you mean by irredeemable debt? Irredeemable debt are no longer issued by the company. It is only for computation purposes. For academic purposes, we will discuss irredeemable debt. Nowadays, the company does not issue irredeemable debt. What is the cost of debt? It is the interest. Interest is a claimable expenditure in your P&L account for tax purposes. So you will have only the net tax, net saving of interest, sorry, net interest out of taxes. So cost of debt is interest into 1 minus tax, divide by net proceeds into 100. Net of tax only will be your cost. Why? Because having bad an interest of, suppose say just 10,000 if interest, 10,000 interest will end up in tax saving, suppose 40% is tax, will end up in tax saving of 10,000 minus 40%, which is 4,000. 6,000 only will be your net cost, because that 4,000 is tax saving on interest. So it is interest into 1 minus T divided by net proceeds into 100. I have told you what net proceeds is. If you are raising the capital in terms of face value of 100 rupees, and if the company is spending on flotation cost, brokerages, then security transaction tax, and any other necessary expenditure for floating the shares or debentures in the market. In such case, it is the net proceeds which is received by the company. Interest into 1 minus tax divided by net proceeds into 100 will give you the cost of debt. If it is redeemable, it is interest into 1 minus tax plus RV minus NP by N divided by RV plus NP by 2. RV plus NP by 2 is the average of proceeds. RV minus NP by N, it is the excess of redemption value paid over the life, because it is one-time payment into 100. These are the formulae. Is it understood so far? Cost of equity, D by P into 100, D1 by P naught plus D, RF plus beta into RM minus RF. Cost of preference shares, D by NP into 100, or D into 1 plus T by NP into 100. Cost of preference shares when it is redeemable, D plus RV minus NP by N divided by RV plus NP by 2 into 100. If dividend distribution tax is charged on the company, D into 1 plus T plus RV minus NP by N divided by RV plus NP by 2 into 100. Cost of debentures, interest into 1 minus tax divided by net proceeds into 100. If the debentures are redeemable, it is interest into 1 minus tax plus RV minus NP divided by N, the whole divided by RV plus NP by 2 into 100. That's all. Is the formulae understood? Now, please come to sums. Please take illustration 1, page number 370 in my book. I'm not sure about the page number in your book. In my book, it's page number 370. Is it the same page number? Right. So, what is told in this question? A company issued 10,000 10% debentures of 100 each at a premium of 10% to be matured on 1/4/2023. The debentures will be redeemed on maturity. Compute the cost of debentures. I don't think so. This is that sum. This is not that sum. I will explain these sums a little later. Illustration 15. Illustration 15, page number 389 in my book. No, not that. Illustration 14. Illustration 14, ma. அதுக்கு முன்னாடி இருக்கிற 14 sums I will discuss with your textbook itself. ரொம்ப simple sums தான் அதெல்லாம். Please take illustration 14, page number 388. Illustration 14, page number 388. Have you all taken? Assuming corporate tax rate of 35%, compute after tax cost of capital in the following situations. Is it that sum? Is it illustration 14? Right. So what is this sum? They have told perpetual 15% debentures. Perpetual in the sense it is not redeemable. Perpetual 15% debentures of 1000 sold at a premium of 10% with no flotation cost. What is the cost of perpetual debentures? It is interest into 1 minus tax divided by net proceeds into 100. How much is net proceeds? It is sold at a premium of 10%. So net proceeds is 1100. There is no flotation cost. In the numerator, you have to find interest. Interest is always computed on face value. How much is face value? 1000 into 15% into 1 minus tax rate, which is 35%. Solve for it, you will get 8.86% as the cost of debt. Coming to the second part of the question, 10-year 14% debentures of 2000 redeemable at par with 5% flotation cost. So 10-year N is life is 10 years. N is 10 years. Okay. 14% debentures, which means the rate of interest is 14%. On what you compute interest? On face value. How much is face value? 2000. 2000 into 14% will give you the amount of interest. Redeemable at par. So redemption value is 2000. 5% is flotation cost. How do you measure net proceeds? 2000 is the face value minus 5% of flotation cost on 2000. You will get 1900 as net proceeds. Here it is a case of redeemable preference shares. So how do you measure the cost of debt? It is interest into 1 minus tax plus RV minus NP by N divided by RV plus NP by 2 into 100. So interest is 280 into 1 minus 0.35 plus redemption value is 2000, NP is 1900, divide by life is 10 years, the whole divide by RV plus NP by 2 into 100. So that is how you get the cost of debt as 9.85%. Is this sum understood? Is it understood? Right. Now, excuse me. Now come to illustration 15. What is told in illustration 15? Calculate the cost of capital from the following cases. 10-year 14% preference shares of rupees 100, redeemable at a premium of 5%, flotation cost of 5%, dividend taxes 10%. So let's discuss one after the other. So let me do first subdivision. 10 years. So life is N is 10 years. 14% preference shares of 100. So the amount of dividend is computed on face value. How much is face value? 100 rupees. On that 14% is dividend. So D is 14 rupees. Redeemable at a premium of 5%. So RV, redemption value, is 100 plus 5%, which is 105. Flotation cost is 5%. How do you find net proceeds? It is 100 minus 5%. So NP is 95. They have told about dividend tax of 10%. So here I will show the cost of preference shares as D into 1 plus T plus RV minus NP by N divided by RV plus NP by 2 into 100. D was 14 into 1 plus 0.1 plus RV is 105, NP is 95, divide by N, which is 10 years, divide the whole divide by the average proceeds. Average proceeds is redemption value plus net proceeds divided by 2 into 100. This will give you the cost of preference shares. Is this subdivision understood? Right. Coming to the second subdivision. An equity share selling at rupees 50, paying a dividend of rupees 6 per share, is expected to continue indefinitely. So they have not given you the growth. It is only dividend model. How do you measure cost of equity? It is dividend per share divided by market price per share into 100. D by P into 100. Correct? So the dividend per share is 6 rupees. Market price is 50 rupees. Into 100, this will give you 12% as cost of equity. Very simple. The third subdivision. The above equity share, if dividend are expected to grow at the rate of 5%. So whenever it is dividend growth model, the cost of equity is D1 divided by P0 plus G. To represent it as a percentage, I multiply with 100. Okay. What is told in the previous subdivision? The above equity share. That is why I am taking the previous subdivision value. An equity share paying a dividend, which means it is in present tense, which means the given information is D0. How do you arrive at D1? It is D0 into 1 plus G. So 6 into 1.05, 6.3 is D1. Given the price of the share is 50 rupees and the growth rate is 5%, D1 divided by P0 plus G. 6.3 divided by 50 plus 0.05. Multiply with 100, you will get the percentage. Is it understood? Right. Then they say the fourth subdivision. An equity share of a company is selling at rupees 120. So 120 is the price of the share. Earnings per share is 20, of which 50% is paid as dividends. So D0 is 20 rupees of earning. On that 50% is paid as dividend, which means 10 rupees is D0. It is in past tense. That is why I call it as D0. The shareholder expects the company to earn a constant after tax of 10% on its investment of retained earnings. So here the growth rate is not explicitly given to me. Instead, they have told the company is earning 10% return on its retained earnings. I told you how I am arriving at growth. The amount of earnings which is retained in the organization will be reinvested in projects and it will fetch you a rate of return. That is how the organization grows. How do you measure the growth rate? It is B into R. What is B? It is the amount of retention. How much of earnings is retained? Out of 20 rupees of earnings, 50% was given away as dividend, which means the remaining 50% is the retention ratio. It is 0.5. This 50%, how is it going to grow? It is going to grow at a rate of return of 10%. So which means the growth rate is 5%. Here in this subdivision, the growth rate was not directly given to us. We found it as B into R. So the cost of equity is D1 divided by P0 plus G multiplied by 100. How do you measure D1? It is D0 into 1 plus G. Because the given information was D0. They say the company has paid a dividend of 50%, which means it is in the past tense. How do you arrive at future dividend? It is G0 into 1 plus G, which is 10 into 1 plus 0.05 divided by 120 plus the growth rate. Entire value multiplied by 100 will give you the cost of equity. Is this sum understood? Is this sum understood? Here in this sum, they have not given us the growth rate. The growth rate we had to find. How will an organization grow? If all the earnings made derived by the organization are distributed as dividend, there will be no growth. So the growth will be on the basis of retention of earnings. How much of earnings is retained? When 50% of earnings is given away as dividend, the remaining 50% is retained. What is the rate of return on investment? It is 10%. So the growth rate is 5%. Having known the growth rate, the given information is about the past dividend. We are bothered about the future dividend, which is D1. How do you measure D1? It is D0 into 1 plus G, which is 10 into 1 plus 0.05 divided by the price of the share, which is 120, plus the growth rate, which is 0.05. The entire value I multiply with 100 to represent it as a percentage. So solve for it, you will get 13.75%. Is it understood? Please take illustration 16. Illustration 16 is based on overall cost of capital. Just 1 minute. I'm going on mute. I'll come back. Okay. So now coming to overall cost of capital. How do you find the overall cost of capital, which is otherwise called as weighted average cost of capital, composite cost of capital, K naught. எல்லாமே ஒரே அர்த்தம் தான். ஓகேவா? கொஸ்டின்ல மாத்தி கேட்டாலும் ஒரே ஆன்சர் தான். Composite cost of capital, overall cost of capital, weighted average cost of capital, K naught, all means the same. That K naught can be computed on two bases. One is book value basis or market value basis. If you are finding it on book value basis or on market value basis, how do we find overall cost of capital? I have already told it in capital structure theories. It is equity divided by total capital into cost of equity plus debt by total capital into cost of debt plus preference share capital divided by total capital into cost of preference shares. What is this equity by total capital? It is weight of equity. This is weight of debt. This is weight of preference shares. So the weight of equity into cost of equity, weight of debt into cost of debt, weight of preference into cost of preference will give you the overall cost of capital. Such overall cost of capital can be computed on book value basis or on market value basis. Which is relevant? Market value basis only is relevant because book value is historical cost. Correct? So the market value basis only will be relevant. Now please take illustration 16. What is told in illustration 16? From the following information, determine the appropriate weighted average cost of capital relevant for evaluating long-term investment projects of the company. They have given us the cost of equity, after-tax cost of long-term debt, of short-term debt, and cost of reserves. So in the absence of information, cost of equity will be the same as cost of reserves. Here they have given us the cost of reserves separately. Always you have to take after-tax cost of debt only, right? The short-term debt does not form part of capital structure. What is short-term debt? It is current liability. Current liability does not form part of capital structure. So you can ignore the short-term debt. So Considering it on book value and on market value, they are asking us to find the weighted average cost of capital. Since they have provided both book value and market value, we will find both. WACC as per book value, equity is 3 lakhs, reserves is 2 lakhs, long-term debt is 4 lakhs, total capital is 9 lakhs. Ignore short-term debt. Short-term debt are current liabilities. It does not form part of capital structure. Okay. How much is the proportion in capital? It is 3 by 9, 2 by 9 and 4 by 9, which is proportion in capital into the respective cost. What is the cost given? They have given all information straight away. Cost of equity is 18%, cost of reserves is 15%, cost of long-term debt is 8%. Again, I am ignoring the cost of short-term debt. The proportion in capital into the respective cost will give you the product. The total of it will give you the weighted average cost of capital. This is on the basis of book value. If I have to find it on market value basis, how much is the market value told? For capital, it is given as 7,50,000. Here, the reserves, it is not nil. I have to find the share of reserves in terms of market value. What will happen to reserves? The reserves are the entitlement of equity shareholders only. So that 7,50,000, I have to split up between how much is capital and how much is reserve, because both have got two different cost of capital. It is not the same 18%. For equity, it is 18%, but for reserves, it is only 15%. So from that 7,50,000, I have to separate how much is capital and how much is reserves. 7,50,000 is the total market value. 7,50,000 is the total market value. How much is the book value of equity capital? It is 3 lakhs divided by 5 lakhs. So 7,50,000 into 3 lakh divided by 5 lakh. How did I get 5 lakhs? 3 lakhs is capital, 2 lakhs is reserves. So total of equity shareholders funds is 5 lakhs. 7,50,000 into 3 lakh by 5 lakh will give you 4,50,000. 7,50,000 into 2 lakh by 5 lakh will give you 3 lakhs. So you get the share of market value for the capital and for reserves. 7,50,000 is given as market value as one single figure. I am separating it into capital and reserves. Why? Because there are two different costs of capital, one for equity and one for reserves. Hence, I have to separate. How do I separate? I separate it in the ratio of book value. So, in the ratio of book value, when I separate, out of 7,50,000, I find 4,50,000 as equity and remaining 3 lakh as reserve. As regards long-term debt is 3,75,000 of market value, which is given. Again, ignore short-term debt. So, having given the total capital structure, find the proportion in capital. How do you find the proportion in capital? 4,50,000 divided by 11,25,000. 3 lakh divided by 11,25,000. 3,75,000 by 11,25,000. This will give you the proportion in capital. The proportion in total capital into the cost will give you the product. The total of the product will give you the weighted average cost of capital. So what are the points to remember here? One is short-term debt you can ignore because it is current liability. It cannot form part of capital structure. We are always supposed to take only after-tax cost. So the given information itself is after tax, so you take it as it is. Here, the cost of equity and cost of reserves are different. If it is same, you can take the market value of 7,50,000 straight away and multiply it with 18% of cost. But here, the cost of equity and cost of reserves are different. So out of that 7,50,000 of market value, I have to find how much is share of equity and how much is share of reserves. So having got 7,50,000 of market value தமிழ்ல என்ன மார்க்கெட் வேல்யூ தமிழ்ல எப்படி ஒரு ஷேரோட மார்க்கெட் வேல்யூமா ஷேர் பிரைஸ் மாறும்ல ஷேர் பிரைஸ் வந்து ஸ்டாக் எக்ஸ்சேஞ்ச்ல ஃபிளக்சுவேஷன்ஸ்ல ஷேர் பிரைஸ் மாறும்ல 100 rupees ஷேர் ஃபேஸ் வேல்யூனா market fluctuationsனால அது 120 rupees ஆச்சுனா 120 rupees into the number of shares will give you the market value. Trading value the market value. Right. So given the market value, I am finding the proposition in total capital into the cost, which will give me the product. The total of product will give me the weighted average cost of capital. Is this sum understood? Right. Now come to the next sum. Illustration 17. Just 1 minute. I'm going on mute. 1 minute. Okay. So what is told in illustration 17? In considering the most desirable capital structure of the company, the following estimates of cost of debt and equity capital have been made at various levels of debt equity mix. So they have given debt as a percentage of capital employed, cost of debt and cost of equity. What is the question? You are required to determine the optimal debt equity mix for the company by calculating the composite cost of capital. What do you mean by composite cost of capital? Weighted average cost of capital. They have given the proportion of debt. They have given us the cost of debt and cost of equity. Having known the proportion of debt, 100% of capital structure, having known the proportion of debt, the remaining will be equity. So, how could you find the weighted average cost of capital? It is the proportion in debt, weight of debt into cost of debt plus weight of equity into cost of equity, right? So what is given? They have given debt as a percentage of total capital employed, 0, 10, 20, 30, 40, 50 and 60, which means the balance will be equity. When 0% debt means it is 100% equity, 10% debt, 90% equity, 20% debt, 80% equity, 30% debt, 70% equity, 40% debt, 60% equity. That is, the balance will be equity in excess of debt. Okay. They have given us the cost of debt and also the cost of equity. How will you find overall cost of capital now? Overall cost of capital, in the first place, it is zero debt, which means the cost of equity is the overall cost of capital. So it is 12%. In the second place, 10% is the weight of debt into cost of debt is 5% plus 90% is weight of equity into 12% is cost of equity. So 10 into 5% plus 90 into 12% will give you the overall cost of capital. Likewise, 20 into 5% plus 80 into 12.5, then 30 into 5.5 plus 70 into 13, then 40 into 6 plus 60 into 14. This is nothing but weight of debt into cost of debt plus weight of equity into cost of equity. Likewise, you have to do it for all the information given. What is the question? The question says you are required to determine the optimal debt equity mix. Which one do you call as an optimal debt equity mix? That which minimizes the overall cost of capital for the firm. Considering the cost of capital for the various alternatives we computed, which is the least? 10.75% is the least cost of capital. This cost of capital I achieve for what composition of debt and equity? I achieve for a composition of 30% of debt and 70% of equity. So thus, optimal debt equity mix is 30% debt and 70% equity, as it minimizes the overall cost of capital. That's all. Is this sum understood? Is this sum understood? Right. Now come to exercise sums. We have a few exercise sums also. We will finish and then come back to this illustrations. Not to worry. I will do every sum in your study material. Don't worry. Exercise sum number 1, page number 461 in my book. Calculate the cost of capital in the following cases. Did you get that? Right. So what is the question? X Limited issues 12% debentures of face value of 100 each, realizes 95 per debenture, redeemable after 10 years at a premium of 10%. So how do you measure interest? It is a case of redeemable debentures. So interest is computed on face value. How much is the interest rate? 12% debentures, which means 12% is the rate of interest. On what do you compute interest? You have to find interest on face value. So 100 into 12%, 12 rupees is the amount of interest. They have told it is redeemable after 10 years at a premium of 10%, which means how much is redemption value? 100 plus 10%. So 110 will be the redemption value. It realizes 95 per debenture. So net proceeds is 95 rupees. Tax rate is 50%, which is given below the note. Both companies are paying income tax at 50%. So tax rate is 50%. Life is 10 years. Substitute the values in the formula. Interest into 1 minus tax rate plus RB minus NP by N divided by RB plus NP by 2 into 100. You know interest, which is 12 rupees, into 1 minus 0.5 of tax rate plus RB is 110 minus NP is 95 divided by life of 10. The whole divide by RB plus NP by 2, which is 110 plus 95 by 2 into 100. This will give you the cost of debt. Are you able to understand? Your book answer is wrong. Just ignore. Are you able to understand? Right. Coming to the second part of the same question. Y Limited issued preference shares of face value of 100 each, carrying 14% dividend. He realizes 92 per share. The shares are repayable after 12 years at par. So this is preference shares. So it is dividend, not I. This is D. Okay. How much is D? It is 14% on face value of 100 rupees, which is 14 rupees. This is D. Okay. Redemption value. It is redeemable at par after 12 years. So redemption value is 100. N is 12 years. Tax rate is 50%. Anyway, this is income tax, not dividend distribution tax. So you will not bring it into cost of preference shares. The net proceeds is 92 rupees. Okay. Substitute the value. Here they have not told about dividend distribution tax. So the cost of preference shares is D plus RB minus NP by N divided by RB plus NP by 2 into 100. I can show you a clear contrast. Just now we discussed one illustration sum. Illustration 15, no, 15 done. 10-year 14% preference shares. Illustration dividend tax 10% in irundhuda. If there is dividend tax, they will specifically mention. Otherwise, you can ignore tax in cost of preference shares. Okay. So cost of preference shares here will be D plus RV minus NP by N divided by RV plus NP by 2 into 100. Having known the values, substitute them in the formula. You will get the cost of preference shares. Is this sum understood? Is it understood? Right. Come to illustration. Come to illustration again now. It should not be illustration 5. It should be some other number. I'll check and tell you 1 minute. Illustration 18. Please take illustration 18. Here what have they told? Determine the weighted average cost of capital using book value as weights and market value as weights based on the following information. They have given rupees 100 debentures 8 lakhs, preference shares 2 lakhs, equity shares 10 lakhs, total capital is 20 lakhs. There is no reserves. Reason market price of all these securities are debentures rupees 110, preference shares 120, equity shares rupees 22. External financing operations are rupees 100 per debenture redeemable at par, 10-year maturity, 13% coupon rate. What do you mean by coupon rate? Interest rate. 13% coupon rate, 4% flotation cost, sale price rupees 100. Okay. Then rupees 100 preference share redeemable at par, 10-year maturity, 14% dividend rate, 5% flotation cost, sale price rupees 100. And equity share rupees 2 per share, flotation cost, sale price 22 rupees. Dividend expected on equity share at the end of the year is 2 per share. Anticipated growth rate is 7%. Company pays all its earnings in the form of dividend. Corporate tax rate is 50%. Okay. So with those information in A, B, and C, I have to find cost of debt, cost of equity, and cost of preference shares. The debentures are redeemable. How do you find cost of debt? Interest into 1 minus tax rate plus RV minus NP by N divided by RV plus NP by 2 into 100. How much is interest? 13% on face value. 100 rupees into 13%. 13 rupees is the amount of interest. Redeemable at par. So redemption value is 100. Net proceeds 4% they have told us flotation cost. So 100 minus 4 rupees. Net proceeds is 96 rupees. Tax rate is given as 50%. So T is 0.5. How do you find cost of debt? Interest into 1 minus tax plus RV minus NP by N divided by RV plus NP by 2 into 100. You get 7.04%. Then come to cost of preference shares. Given the debenture preference dividend is 14% on face value of 100. So 100 into 14%, 14 rupees. The life is 10 years again. How much is the flotation cost? 100 rupees minus 5% is the flotation cost. It is redeemable at par. Redemption value is 100. Substitute the values in the formulae. Here again, they have not told about dividend tax. So I take dividend as it is. Dividend plus RV minus NP by N divided by RV plus NP by 2 into 100. This will give you the cost of preference shares. For cost of equity, what have they told? They have told 22 rupees is the share price, 2 rupees is the flotation cost, which means 20 rupees is the net proceeds. About the dividend, dividend expected on equity share is 2 rupees, which means the given information itself is D1. They have not told it in the past tense or in the present tense. They are telling it only in future tense. So the given information itself is D1. D1 is 2 rupees. How much is the growth rate? 7%. With that, find cost of equity. D1 divided by P0 plus G. While finding P0, subtract the flotation cost and only the net proceeds we have to take. So you get the cost of equity as 17%. Having known this, you can find the weighted average cost of capital. If it is on book value, they have told the capital structure 8 lakh, 2 lakh and 10 lakh. Find the proportion in capital. 8 lakh divided by 20 lakh, 2 lakh divided by 20 lakh, 10 lakh divided by 20 lakhs. This will give you proportion in capital into the respective cost we just found. Correct? Cost of debentures, cost of preference and cost of equity we just found. Multiply the weights with the cost, you will get the product. The total of product will give you the weighted average cost of capital. This is on book value. If you have to find it on market value, how do you find the market value? 8 lakh is the value of debentures. Okay, wow. How much is the face value? Divide by 100. That will give you the number of debentures. What is the market price? 110. So 8 lakh divided by 100 will give you the number of debentures into 110 of market price will give you the market value of debentures. Likewise, find the market value of preference and of equity. For preference, 2 lakh is the preference share capital, 100 rupees is the face value. If you divide, you will get the number of preference shares into the market price per share. Then 10 lakh is the equity capital, 10 rupees is the face value. So if you divide, you will get 1 lakh shares into market price of 22 per share. You will get the market value of equity share. Having known the market value, find the proportion in capital. 8 lakh 80,000 divided by 3320. 2 lakh 40 divided by 3320. 22 divided by 3320. This will give you the proportion in capital. The cost will not change. The cost will be the same whether it is book value or market value. So you get the cost of capital, multiply the proportion with the cost to get the product. Total of product will give you the weighted average cost of capital. That's all. Is this sum understood? Right. Then comes illustration 19. Please take illustration 19. The present capital structure of a company is as follows. They have given us equity share capital 240 million, reserves 360 million, 11% preference shares 120 million, 12% debentures, 14% term loans. Additionally, the following information are available. Company's equity beta is 1.06, yield on long-term treasury bonds is 10%, stock market premium is 6%. Current ex-dividend equity share price is 15 rupees. Ex-dividend preference share price is 12 rupees. Ex-interest debenture market value is 102.5 for 100. Corporate tax rate is 40%. The debentures are redeemable after 3 years and interest is paid annually. Ignore flotation cost. Calculate the company's weighted average cost of capital. Here again, your book answer is wrong. And alternatively, no solution போட்டிருக்காங்க தெரியுமா அது தப்பு. Alternatively வந்து தப்பு. Okay, right. So here again, they have given you the capital structure. They have given certain information with which I have to find the cost. எதுக்கெல்லாம் cost கண்டுபிடிக்கணும்? Cost of equity, cost of preference shares, cost of debentures and cost of term loans. Okay. How do you find cost of equity here? They have given information for beta, yield on long-term treasury bonds. Treasury bonds are government bonds. So any return on government bonds are risk-free. Okay. So the cost of equity I will find using the CAPM model. Why should I use CAPM model? Because they have given me information to apply that model only. 1 minute. Right. How do you measure the cost of equity? It is RF plus beta into RM minus RF. How much is RF? It is the return which is the risk free. That is 10%. It is on treasury bonds. Plus beta. How much is beta? It is given as 1.06. They have told stock market risk premium RM minus RF is straight away given to me. Risk premium is RM minus RF, which is given as 6%, which is 0.06. So you get cost of equity as 16.36%. After this, for finding the cost of debt, they have told 12% debentures, which means interest rate is 12% on face value. How much is face value? Rupees 100. How did I know rupees 100? Look at the table, second table. Current X interest debenture market value 102.5 per 100, which means 100 is the face value, 102.5 is the market price. Okay, so 100 rupees of face value on that 12%, I will get 12 rupees as interest. The life of debentures is 3 years. They have told the debentures are redeemable after 3 years. Interest is paid annually. So N is 3 years. Tax rate is given as 40%. They have told they are redeemable after 3 years. They have not told about how is it redeemed, which means it is redeemed only at par. If it is redeemed at premium, they have to specifically mention. If nothing is told, the redemption is at par. The redemption value is 100 rupees. How much is the net proceeds received? They have told 102.5 per 100, which means for every share 102.5 is collected. That is net proceeds. That is 102.5. Substitute the values in the formula. Cost of debt is interest into 1 minus tax plus RV minus NT by N divided by RV plus NT by 2 into 100. Right? So how much is interest? 12 rupees into 1 minus tax rate plus redemption value is 100. Net proceeds is 102.5, which is the market price, divide by life of 10 years, 3 years, not 10 years, life of 3 years, divide by the average proceeds into 100, you will get the cost of debentures. Okay. Then coming to cost of preference shares. Have they told 11% preference shares of face value of 10? Yes. So how do you get the dividend on preference shares? 10 into 11%, 1.1 is the dividend. How do you find cost of preference shares? It is dividend divided by net proceeds into 100. How much is the net proceeds on preference shares? Look at the current ex-dividend preference share price, 12 rupees. So the price is 12 rupees. So 1.1 divided by 12 rupees into 100, you get cost of preference as 9.17%. Okay. Then coming to cost of term loans. What is the cost of term loans? Cost of term loans is given as 14%. Look into the first table. They have told 14% term loans, which means 14% is the rate of interest on term loans. Whenever there is interest, there will be tax saving on interest. So you have to always consider post-tax cost. What is the cost net of taxes? So it is 14% into 1 minus 0.4, which will give you 8.4% as cost of term loans. Have they given us reserves in this question? Yes. Have they told anything specific about cost of reserves? No, which means the cost of equity will be the same as cost of reserves because the reserves belongs to the shareholders. Hence, cost of reserves will be the same as cost of equity, which we just found as 16.36%. Is the cost computation clear? Is the cost computation understood? No. Is the cost computation understood? Fine. After this, we will move into computation of overall cost of capital. If you have to do it on book value basis, the book value is already given to you. 240, 360, 120, 120 and 360. So it is 1200, correct? With that, find the proportion in capital. 240 divided by 1200, 360 by 1200, 120 by 1200. Likewise, find the proportion in capital. We just found the cost. Cost of equity was the same as cost of reserves. We found the cost of preference shares, cost of debentures, and cost after tax cost of term loans. Multiply proportion in capital into cost, you will get the product. The total of product will give you the weighted average cost of capital. If you have to do it on market value basis, what is told about market value? They have told the current ex-dividend share price is rupees 15. How much is the share capital? 240. 240 divided by 10 will give you the number of equity shares. Into 15 rupees of market price will give you 360 as equity. But what is happening to reserves? Reserves will continue to be the same 360 as in book value. You should not ignore reserves. So reserves will continue to be the same as 360 as in book value. Then for preference shares, it is 12 rupees. So how much is the book value? 120 divided by 10. 120 is the value. Divide by 10 rupees per share will give you the number of preference shares. Into 12 rupees per preference share will give you 144. Come to debentures. 120 divided by 100 of face value into 102.5, you will get 123. Term loans also you will take at its given value itself. Now find the revised proportion in capital, but the cost change. Cost will not change. Only the proportion will change based on market value. Proportion in capital into cost, you find the product. The total of product will give you the weighted average cost of capital. That's all. Is this understood? Is it clear? Here in your study material, they have made a lot of mistakes. Just ignore. Is it clear? Right. Very good. Now, coming to valuation of right shares. I will tell you this. Just 1 minute. Now coming to right shares. What is about right shares? Right. First know what right shares are. For the existing shareholders, the shares may be issued at a later stage at a lower price. That right of issue of shares at a lower price is available only to the existing shareholders. Okay, va? Share issue different share issue one public issue of shares, then rights issue, bonus issue. In case of bonus issue, there will be no share price. It will be given free of cost to the existing shareholders. In case of rights issue, It is issued to the existing shareholders, but at a lesser share price. Suppose if the public is given the share at rupees 10, the existing shareholders will be given at rupees only 8 only. Why? They are given at a lesser price to the existing shareholders. That is the right share. Right share is a share which is issued to the existing shareholders. It will be issued at a price which is lesser than the market price. Okay. How are we going to value such right? It is measured as, this is just the formula. You need not remember this formula. I will tell you the logic. M minus Mn plus SR divided by N plus R, where M is the share price, M into N. M is the share price, N is the number of existing shares. S is the share price of rights issue, R is the number of right shares, divide by N plus R. This is just the formula. You need not remember this formula. I will tell you the logic from illustration 20. I will tell you the logic from illustration 20. What is told in this sum? Bombay Cotton Mills Limited makes a rights issue at rupees 5 a share of one new share for every 4 shares held. Before the issue, there were 10 million shares outstanding and the share price was rupees 6. Based on the above information, you are required to compute total amount of new money raised, how many value of one right are required to buy one new share, what is the value of one right, what is the prospective X rights price. Okay, what is told? The total amount of new money raised. How many shares are they having? There were 10 million shares outstanding. Okay, you know 1 million is 10 lakhs, correct? How much is 10 million then? It is 100 lakh shares. For this 100 lakh shares, how are they going to do the rights issue? One share for every 4 shares held. Sum number 20, illustration 20, Bombay Cotton Mills Limited. They have told their company is already having 10 million shares. How much is 10 million? It is 100 lakh shares. 1 million is 10 lakhs, which means 10 million is 100 lakh shares. For this 100 lakh shares, which they are already having, how much is the rights issue going to be made? They say one new share for every 4 shares held. So 100 lakhs divided by 4. 25 lakh shares will be issued by rights. How much is the right share price? Right issue at 5 per share, which means 25 into 5, 125 lakhs of money is going to be raised by rights issue. They are already having 10 million shares. For every share, one new share for every 4 shares held are given as rights issue, which means the number of shares issued through rights will be 25 lakh shares. How much is the share price of rights issue? 5 rupees per share, which means how much of money is going to be raised? 125 lakhs, which is 1 crore and 25 lakhs. Okay. Subdivision B. How many value of one right are required to buy one new share? If you want to buy one right share, you should be a holder of 4 shares already. How? They have told one new share for every 4 shares held. So if you are a shareholder in a company, you should be holding 4 shares to get 1 share. Okay. So 1:4 is the value of one right required to buy one new share. Okay. Then coming to value of one right. I have written the formula once more. I will explain this with logic. How much is the share price? 6 rupees. How much is the rights issue price? 5 rupees. So how much is the benefit derived? Don't tell me 1 rupee. No. If you are buying 4 shares at 6 rupees, you will get 1 share at 5 rupees. So the benefit is not 1 rupee, which is 6 minus 1. No. Only if you spend 6 rupees on 4 shares, you will get 1 share at 5 rupees, which means how much is your total outflow? For you to get that one share at 5 rupees, you have to already buy 4 shares, then one right share. So totally it is 5 shares, which means I find the average price. How do I find the average price? If I buy 4 shares at 6 rupees, I will get one share at 5 rupees, which means how much is my total spending? Total spending will be 24 plus 5. For how many number of shares? 5 shares. So 29 divided by 5. My spending is 5.8. But how much is the original share price? 6 rupees, which means how much is the benefit derived because of this rights issue? It is not 1 rupee. It is 20 paise only. Are you able to understand? ஒரு ஷேருக்கு 6 ரூபா விலை, ரைட் ஷேரோட விலை 5 ரூபா. ஆனா அந்த ரைட் ஷேர் வாங்குறதுக்கு எனக்கு 4 ஷேர் இருக்கணும் 6 ரூபா கொடுத்து வாங்கி. அப்படின்னா நான் என்ன ஆவரேஜ் பிரைஸ்ல ஒரு ஷேர் வாங்கியிருப்பேன்? 6 rupees கொடுத்து 4 ஷேர் வாங்கினாதான் ஒரு ஷேர் 5 ரூபாய்க்கு கிடைக்கும். மொத்தம் எவ்வளவு ஷேரு? 5 ஷேர்ஸ். அப்படின்னா என்னோட மொத்த அவுட்ஃப்ளோ ஆவரேஜா ஒரு ஷேருக்கு எவ்வளோ? 5.8. ஆனா என்னோட ஆக்சுவல் ஷேர் பிரைஸ் எவ்வளோ? 6 rupees. Now, how much is the value of right? It is the benefit derived, which is 20 paise only. Are you able to understand the formula? M minus Mn plus Sr divided by N plus R. Are you able to understand? The last part of the question, what is the prospective X rights price? What do you mean by X rights? Excluding the rights value, how much is the share price? That is what you call as X rights price. Excluding the rights value, how much is the share price? 6 rupees is the share price. The value of right is 0.2. So excluding the rights value, the share price is 5.8. Is it understood? And the formula M minus Mn plus Sr divided by N plus R. Formula wala ஞாபகம் வச்சுக்காதீங்க. It is the average price. அவ்வளவுதான். Is it understood? Right. Right. Now come to illustration 21. Illustration 21. What is told here? Aries Limited wishes to raise additional finance of rupees 10 lakhs for meeting its investment plans. It has 2,10,000 in the form of retained earnings available for investment purpose. The following are the further details. Debt equity makes 30%, 70%. Cost of debt up to 1,80,000 is 10% before tax. Beyond 1,80,000 is 16% before tax. Earnings per share is 4 rupees. Dividend payout is 50%. Expected growth rate is 10%. Current market price is 44 rupees. Tax rate is 50%. You are required to determine the pattern for raising the additional finance. Determine the post-tax average cost of additional debt. Determine the cost of retained earnings and cost of equity. Compute the overall weighted average after-tax cost of additional finance. Okay, ஒன்னொன்னா answer பண்ணலாம். How much is the additional finance required? They want an additional finance of 10 lakhs. How are they going to raise it? Debt equity mix is 30% and 70%. Correct? So 30% is debt, which is 3 lakh of debt. 70% is equity, which is 7 lakh of equity. Out of 7 lakh of equity, they already have a retained earnings of 2 lakh and 10,000, which means the remaining 4,90,000 will be raised by issue of equity shares. For 3 lakh of debt, they have given the cost of debt. Up to 1,80,000, it is 10%. Beyond 1,80,000, it is 16%. How much is total debt? 3 lakh. 3 lakh la 1,80,000 ku cost of debt is 10% before tax. Okay. Beyond 1,80,000, it is 16%. How much is the debt beyond 1,80,000? Total debt is 3 lakhs. 1,80,000 is 10% cost, which means how much is beyond 1,80,000? 1,20,000. For that, the cost is 16%. These both cost 10% and 16% are before tax. We should always consider after-tax cost of debt. So how do you get after-tax cost of debt? It is interest into 1 minus tax rate. Okay, so 10% into 1 minus 0.5. Here it is 16% into 1 minus 0.5. So you get after-tax cost of debt. Having found the after-tax cost of debt, what is the question? Determine the pattern for raising additional funds. Done. Determine the post-tax average cost of additional debt. So how do you find the total cost of debt? We know up to 1,80,000 it is 5%, and after that it is 8%. How do you find the total cost of debt then? 10% into 1 minus 0.5, which is after tax cost of debt, into 1,80,000 divided by 3 lakhs, plus 16% into 1 minus 0.5 into 1,20,000 divided by 3 lakhs. For 1,80,000 of debt, the cost is 5%. For 1,20,000 of debt, the cost is 8%. I'm talking about after tax. Okay. So what is the total cost of debt? Total cost of debt will be 6.2%. Coming to cost of equity, they have told about the dividend payout is 50% of earnings. How much is the earnings per share? 4 rupees. On that 50%. So D0 is 2 rupees. How do you find D1? They have given growth rate is 10%. D1 is D0 into 1 plus G. So 2 into 1 plus 10%, which will give you D1, divide by P0. What is the price of the share? The current market price of the share is 44 rupees. So it is D1 divided by P0 plus the growth of 10%, which will give you the cost of equity. Cost of equity is 15%. Cost of equity is the same as cost of retained earnings, which is 15% again. Okay. Now coming to weighted average cost of capital. How do you find weighted average cost of capital? Determine cost of retained earnings and cost of equity. Cost of retained earnings is the same as cost of equity. It is the same 15%. Now coming to weighted average cost of capital, you have equity capital, reserves, two debts. One is 10% debt and the other is 16% debt. Okay. How much was the additional finance raised? 10 lakhs. How did you raise it? 4,90,000 was by issue of equity shares. 2,10,000 was reserve. 1,80,000 was 10% debt. Remaining 1,20,000 was 16% debt. Find the proportion in capital into the cost. Cost of equity is the same as cost of reserves. For cost of debt, I am taking post-tax cost of debt. 10% na net of tax is 5%. 16% na net of tax is 8%. Multiply the weight and the cost. You will get the product. Total of product will give you the weighted average cost of capital. Are you able to understand? The same page is repeated. Weighted average cost of capital is 12.36%. Is it clear to all of you? Now come to exercise sum. Come back to exercise. We are left with very few sums in 1 minute. Exercise sum number 2. Exercise sum number 2. Is this sum clear? Is the earlier sum cost of raising additional finance? Was that clear? Right. Now come to exercise sum number 2. Exercise sum number 2. Calculate the approximate cost of company's debenture capital when it decides to issue 10,000 numbers of 14% non-convertible debentures, each of face value rupees 100. The debentures are redeemable at a premium of 10% after 10 years. The average realization is expected to be 92. Tax applicable to the company is 40%. So here again, you will not get the book answer. It is wrong. You can just ignore it. They have told the redemption value is 10% of premium, 100 plus 10%, 110. Net proceeds is 92 rupees. N is 10 years, which is the life. Tax rate is 40%. How much is interest? 14% on face value of 100 rupees into 1 minus tax plus RV minus MP by N divided by RV plus MP by 2 into 100. You will get a cost of debt of 10.09%. You will not get the book answer. It is wrong. You can just ignore it. Is this sum clear? Now please take exercise sum number 3, JKL Limited. Exercise sum number 3, JKL Limited. Just 1 minute. Okay. So now please take exercise sum number 3. JKL Limited has the following book value capital structure as on 31st March 2016. Equity share capital 40 lakhs, preference shares 10 lakhs, debentures 30 lakhs, total capital is 80 lakhs. Equity share of the company sells for rupees 20. It is expected the company will pay next year a dividend of 2. So given information itself is D1 only. Okay, which is expected to grow at 5% forever. Assume 35% corporate tax rate required. Compute weighted average cost of capital based on the existing capital structure. Subdivision 2. Compute the new WACC if the company raises an additional 20 lakh debt by issuing 12% debentures. This would result in increasing the expected equity dividend to 2.4, leave the growth rate unchanged, but the price of equity share will fall to rupees 10 per share. Okay. So how do you find cost of equity? They themselves have given us the expected dividend. The company will pay next year. So the given information itself is D1 only. The price of the share is 20. Growth rate is given as 5%. With that, find cost of equity as 15%. For preference shares, cost of preference shares is 11.5%, which is given in the table, 11.5% preference shares. So it is 11.5% only. For cost of debt, it is given as 10% debentures. We have to take after tax. Tax rate is 35%. So 10% into 0.65, you will get cost of debt. Find, post it in your capital structure. How much is your capital structure? 40 lakhs, 10 lakhs, 30 lakhs. So total is 80 lakhs of capital. Find the proportion in capital. 40 lakhs divided by 80 lakhs, 10 lakh by 80 lakh, 30 lakh by 80 lakh. That will give you the proportion in capital into the respective cost. You will get the weighted average cost of capital. This is for the existing capital structure. What is happening to the revised capital structure? They are raising additional capital. How are they raising additional capital? 20 lakhs by issuing 12% debt. Okay. Because of this, what is happening? This will result in increasing the expected equity dividend to 2.4. So D1 will become 2.4, leaving the growth rate unchanged, which is same 5%, but reducing the price of equity share to 10 rupees. So the price of share will become 10 rupees. Find cost of equity. D1 divided by P0 plus G. 2.4 divided by 10 plus 0.05. So you get cost of equity as 29%. Cost of preference is the same, 11.5%. For the existing debt, it is 10%. After tax is 6.5. For the additional debt, it is 12%. After tax is 7.8. So with this, find weighted average cost of capital. So 40 lakhs, 10 lakhs, 30 lakhs is from the existing capital structure. 20 lakhs is because of the additional debt. Find the proportion in capital, multiply with the respective cost. You get the product. The total of the product will give you the weighted average cost of capital. The subdivision 2 part of the solution is wrong from your study material. You can just ignore it. Is it understood? Is it understood? Excuse me. Right. Now we will do one last problem. Again from your exercise. Sum number 4. No, not that. Not sum number 4. Sum number 5. Very limited. Question number 5. Very limited. We will do this as the last sum for today. And we will continue in the next class. What is Merry Limited? Merry Limited has earnings before interest and tax of 30 lakhs, 40% tax rate. Its required rate of return on equity in the absence of borrowings is 18%. In the absence of personal taxes, what is the value of company in MM world with no leverage, with 40 lakhs debt, 70 lakhs in debt? You know MM approach, capital structure, value of levered firm, value of unlevered firm. Value of a levered firm is value of unlevered firm plus debt into tax rate. Do you remember? Value of unlevered firm is EBIT into 1 minus T divided by overall cost of capital. So this sum is based on that. First, find the value of levered firm. How do you find the value of levered firm? It is EBIT into 1 minus tax divided by overall cost of capital. How much is EBIT given? 30 lakhs. How much is tax rate given? 40%. So 30 lakhs into 1 minus 0.4 divided by the overall cost of capital is 18%. Cost of equity will be the overall cost of capital in the absence of debt. Correct? So unlevered firm now, there is no debt in its capital structure. When there is no debt in capital structure, cost of equity will be the overall cost of capital. Hence it is 18%. You get the value of an unlevered firm. How do you get the value of levered firm then? It is value of unlevered firm plus debt into tax rate. So that is how you get the value of a levered firm when there is a debt of 40 lakhs and a debt of 70 lakhs. That's all. Is this sum understood? This was what capital structure theories of MM approach. Is this some clear? Right. We stop with this for today. We will continue in the next class. We have little more from this chapter to cover. Maybe another half an hour. I'll share the PDF in the group in a while. So, and I will complete this chapter in the next class. And please take study note 9, exercise sum number 2.7. Yeah, exercise sum number 4. Please take study note 9, exercise sum number 4. In my book, it's page number 462. Okay, let me read the question. 3 companies A, B, and C are in the same type of business and hence have the similar operating risk. However, the capital structure of each of them is different, and the following are the details. Equity share capital, face value of rupees 10 per share, they have given the value. They have told the market value per share, the dividend per share, debentures face value is given, market value per debenture is given, and the interest rate is given. Assume the current level of dividend are generally expected to continue indefinitely and the income tax rate is 50%. You are required to compute the weighted average cost of capital of each company. So there are 3 companies, A, B, and C. How do we find the weighted average cost of capital? Generally, we do it on market value basis because book value is historical cost. Okay. So weight of equity into cost of equity plus weight of debt into cost of debt will give us the overall cost of capital. How do you measure cost of equity? They have not given us the growth rate here. They have told they expect the dividends are generally expected to continue indefinitely. There is no growth in dividends. So how do you estimate the cost of equity? It is D by NP into 100. So for company A, the dividend is 2.7, market price is 15, page number 462, exercise sum number 4. 2.7 divided by 15 into 100. For company B, it is 4 by 20 into 100. And for company C, it is 2.88 divided by 12 into 100. This will give you the cost of equity. For debentures also, they have not told about the redemption of debentures. Hence, the cost of debt will be interest into 1 minus tax rate divided by net proceeds into 100. For company A, there is no debt. For B, the interest rate is given as 10% on the face value of 100 rupees. So, the interest amount is 10 rupees into 1 minus tax rate, which is 1 minus 50%, divided by the market price of debenture, which is 125. Then for C, it is 8% on the face value, which will give you 8 rupees into 1 minus tax rate, divided by the market price, which is 80 into 100. So this will give you the cost of debt. Having found the cost of equity and cost of debt, I have to find the study note 9 exercise sum number 4. To find the weighted average cost of capital for company A, I am doing it on market value basis, equity shares and debentures. For company A, there is no debentures. What is the market value of debentures? 4 lakh is the, sorry, equity shares, market value of equity shares. 4 lakh is the equity share capital. Divide by 10 rupees per share will give you the number of shares into 15 rupees, which is the market price. So you get market value of 6 lakhs. 100% is in equity in case of company A. There is no debt. Into the cost of equity will give you the overall cost of capital. Then for company B, they have given 2,50,000 is the share capital. Divide by 10 rupees per share will give you the number of shares into the market price of 20 per share. It will give you the market value. For debentures, 1 lakh divided by 100 will give you the number of debentures into 125 per debenture will give you the value. So total is 6,25,000. What is the proportion in capital? 5 lakh divided by 6,25,000. 1,25,000 divided by 6,25,000. So you get the proportion in capital. Multiply with the respective cost of company B, you will get the product. The total of product will give you the weighted average cost of capital for B. For C also, it is 5 lakh divided by 10 rupees of face value will give you the number of shares into 12 rupees per share will give you the market value. For debentures, 2,50,000 divided by 100 will give you the number of debentures into 80 rupees per debenture will give you the market value of debentures. With that, you can find proportion in capital. 6 lakh by 8 lakh, 2 lakh by 8 lakh. This will give you the proportion in capital. Into the respective cost of company C, the product of it, the total of the product will give you the weighted average cost of capital. That's all with this sum. Is this sum understood? Right. Now come to exercise sum number 6. Exercise sum number 6. Company X and Y are identical in all respects, including risk factors, except for debt or equity. Company X having issued 10% debentures of 18 lakhs, while company Y has issued only equity. Both companies earn 20% before interest and tax on their total assets of 6 lakhs. Assume tax rate of 50%, capitalization rate of 15% for an all equity company. Compute the value of companies X and Y using net income approach and net operating income approach. This sum is very similar to the illustration number 31 in my book. This sum is very similar to illustration in my book. It's illustration 31. Okay, ma? So here they have asked us the value of the company X and Y under net income approach and net operating income approach. In that sum, if you have attended my class, you would have known. I told you when the tax rate is given and when the firm is classified into levered and unlevered firm, although the question talks about net operating income approach, we will do it under MM approach, because only under MM approach, the firm is classified into a levered and an unlevered firm, and tax rate is applicable only under MM approach. Okay, so here this sum I will do it both under net income approach and MM approach, not net operating income approach. Okay, because MM approach is an extension of net operating income approach. You start with income statement, EBIT. How do you measure EBIT? 30 lakhs of assets, 20% is the return, which means 6 lakhs is EBIT, minus interest. Who has debt in capital structure? X. How much is the interest rate? 10%. How much is the debt? 18 lakhs. So 18 lakhs into 10%, 1,80,000 will be the interest. 6 lakh minus 1,80,000 will give you 4,20,000 as earnings before tax. Minus tax, you will arrive at earnings after tax. How do you find the value of firm? Value of firm is value of equity plus value of debt. How do you measure value of equity? It is earnings available to equity shareholders divided by cost of equity. What is cost of equity given? The capitalization rate is 15% for an all equity company. So cost of equity is 15%. So earnings available to equity shareholders divided by cost of equity will give you the value of equity, plus value of debt will give you the value of firm. This was under net income approach. Next, coming to net operating income approach, although we are not doing it under net operating income approach, here we classify the firm into a levered firm and an unlevered firm. Which is a levered firm here? The firm which has debt in its capital structure is the levered firm. So company X is a levered firm. Company Y will be an unlevered firm. First, we have to find the value of unlevered firm. After finding the value of unlevered firm, with that you will find the value of a levered firm. Value of levered firm is value of unlevered firm plus debt into tax rate. So first let's find the value of an unlevered firm. How do you find the value of an unlevered firm? It is EBIT into 1 minus tax divided by overall cost of capital. So how much is EBIT? It was 6 lakhs. How did I get 6 lakhs? 30 lakhs into 20%. So 6 lakhs is EBIT into 1 minus tax divided by overall cost of capital. For an unlevered firm, it is an all equity firm. The cost of equity will be the overall cost of capital. So it is 15%. Hence you get the value of unlevered firm. With that, how can you find the value of a levered firm? It is value of unlevered firm, which is the same 20 lakhs plus debt into tax rate. How much is debt? 18 lakhs. How much is tax rate? 50%. So you will get 9 lakhs there. 20 lakhs plus 9 lakhs, 29 lakhs is the value of levered firm. That's all. Is this sum understood? Right. Now you can check on the exercise sums. We have done all sums in the exercise. Please check and confirm. Have we done all sums in the exercise? If you have regularly attended all my classes, you would have known we have done all sums in the exercise. Now come to illustration number 1 minute. Illustration number 52. Please take illustration number 52. After this sum, I will stop sharing the screen and bring in your study material itself. In that study material, the first few sums were all missed, correct? So we will quickly do that. With that, study note 9 is complete. We have so far completed 5 topics: time value of money, cost of capital, dividend policy, leverage analysis, and capital structure theories. We have so far covered 5 topics. Okay, right. So now please take illustration number 52. ABC Limited wants to raise 5 lakh as additional capital. Page number in my book, it's 454. Illustration 52, page number 454. ABC Limited wants to raise 5 lakhs as additional capital. It has two mutually exclusive alternative financial plans. The current EBIT is 17 lakhs, which is likely to remain unchanged. The relevant information they have given: present capital structure is 3 lakh equity shares of 10 each and 10% bonds of 20 lakhs. Tax rate is 50%. EBIT is 17 lakhs. EPS is 2.5. Market price is 25 per share. For financial plan 1, they have told 20,000 equity shares at 25. Financial plan 2 is 12% debentures of 5 lakhs. What is the indifference level of EBIT? And identify the financial break-even level. Okay. So now they are asking you for an indifference level of EBIT. Let's go back way back to the second session where under the choice of a capital structure, I said an optimum capital structure will be one which maximizes the earnings per share. If they have given us the PE ratio, the capital structure which maximizes the market price of the share will be the recommended capital structure. Here, they are asking us for the indifference level of EBIT. What does it mean then? It means that irrespective of the plan 1 or plan 2 of expansion, how much of money they want for expansion? They want 5 lakhs as additional capital, for which they have two plans. One is to raise in the form of equity shares and the other in the form of debentures. If both gives me the same EPS, that is called as indifference level. You are indifferent whether you are choosing equity or debt. So when will you be indifferent? When both gives you the same conclusion. So when both the projects give you the same EPS or the both financial plans give you the same EPS, such is called as indifference point. For such indifference point, they are asking how much should be the EBIT. How much should be the EBIT so that the EPS of the two plans becomes equal. That is what is meant by indifference level of EBIT. For the level of EBIT, which is not known to us, for the level of EBIT, the EPS under plan 1 and plan 2 will be the same. So they are asking us to find it. How do you present an income statement? It will be EBIT minus interest into 1 minus tax, which will give you earnings after tax. Correct? EBIT minus interest. The entire value will give you the earnings before tax. Into 1 minus tax will give you earnings after tax. Minus preference dividend will give you the earnings available to equity shareholders. Divide by number of shares will give you the earnings per share. It is the same income statement only, which they have represented horizontally. Instead of a vertical income statement, it is represented horizontally. What is happening here? EBIT minus interest will give you earnings before tax. Into 1 minus T will give you earnings after tax. Minus preference dividend will give you earnings available to equity shareholders. Divide by number of shares will give you earnings per share. This is as per plan 1. Equated to earnings per share as per plan 2. Only then it is called as indifference level. EPS of both the plans will be the same. Whether it is plan 1 or plan 2, EPS will be the same. How do you arrive at EPS? It is the earnings available to equity shareholders divided by the number of equity shares. So now this sum, in this sum, they say plan 1 is by raising through equity and plan 2 is by debt. Assuming EBIT as X, they are asking us indifference level of EBIT. They are asking us to find the amount of EBIT. So I assume it as X minus interest. How much is interest? They have given the current debt is 20 lakhs into 10%. Correct? So in plan 1, if I am going to raise the additional capital by equity, I will have interest only on existing debt. Okay. How much is the existing debt? 20 lakh bonds into 10%. So 2 lakh is the interest on existing debt. In plan 2, 20 lakhs of existing debt into 10% is 2 lakh interest on existing debt. Additional debt is 5 lakhs, for which it is 12% of interest. So 5 lakh into 12%, 60,000 is the additional interest. So totally the amount of interest will be 2 lakh and 60,000. EBIT minus interest into 1 minus tax rate. So it is x minus 2 lakhs into 1 minus 0.5. 50% is the tax rate which is given, minus preference dividend which is not given in this sum. So it is minus 0. Divide by the number of equity shares. How many number of equity shares? Under plan 1, it is the existing shares of 3 lakhs plus additional shares of 20,000. So it will be 3,20,000 under plan 1. Under plan 2, the total number of shares is only 3 lakhs because the additional capital is raised by debt. So N1 is 3,20,000 and N2 is 3 lakhs. Equate, solve for X. So what is happening? X minus 2 lakh into 0.5 divided by 3,20,000 is equal to X minus 2,60,000 into 0.5 divided by 3 lakh. 0.5 to the left and 0.5 to the right will get cancelled. You can strike off 4 zeros in the denominator. So 4 zeros to the left and 4 zeros to the right. So when you cross multiply, what will happen? This becomes 30 into x minus 2 lakhs, which is equal to 32 into x minus 2 lakh and 60,000. Solve for x. You will get 11 lakh and 60,000. So with 11 lakh 60,000, your answer is done. But still, I wanted to show the proof. Under plan 1, under both plans, the EBIT will be the same. Okay. How much is the interest? For plan 1, it was 2 lakh. For plan 2, it was 2 lakh 60,000. Minus tax at 50% gave me earnings after tax. There is no preference dividend in this sum. Divide by the number of equity shares. It gave me the same earnings per share. So this is what is called as indifference level of EBIT. What should be the amount of EBIT such that however I raise the capital for additional expansion, it will give me the same EPS. So this is indifference between plan 1 and plan 2. Is this sum understood? For the same sum, they have asked for financial break-even. What do you mean by financial break-even? You must have studied marginal costing as part of cost management. What is break-even? No profit, no loss, which means contribution is equal to fixed cost. Correct? That is operating break-even. Here they are asking us financial break-even. What is financial break-even? Your earnings before interest and tax must be sufficient to pay interest. Financial break-even is a point where EBT is 0. Okay. Financial break-even is a point where EBT is 0, where your earnings before interest and tax is sufficient to pay interest. So they are asking you for this sum, financial break-even level. Financial break-even level is nothing but EBIT. Okay. So how much is EBIT? In plan 1, it is 20 lakh into 10%. In plan 2, it is 20 lakh into 10% plus 5 lakh into 12%. So plan 1 and plan 2, that will give you the EBIT. Your EBIT should be this much so that you arrive at break-even. Financial break-even is a point where EBT is 0, where your EBIT is sufficient to cover the interest. That's all. Is this sum understood? Right. With this, study note 9 as per my material is complete. Now I will take you into the textbook. We will do all pending sums and quickly finish off this chapter, and then we will move on to capital budgeting.